Home prices are falling in parts of the United States, but the cost of owning those homes is exploding. Insurance premiums are surging. Property taxes are climbing. Jobs are becoming less secure. And in several states, homeowners are discovering that even as prices drop, they are losing money faster than ever before. This is not a housing recovery, it is a trap. Across the country, foreclosure filings are rising during what is still being described as an economic expansion. Inventory is piling up. Buyers are pulling back, and entire markets are quietly slipping out of balance. So which states are breaking first, and why is this happening now, before the recession is even official? To understand why certain states are unraveling faster than others, we need to step back and look at what makes this housing downturn fundamentally different from previous cycles. In October 2025 alone, foreclosure filings across the United States reached 36,166 properties, a 20% increase year over year. That number by itself would already be concerning. But the timing is what makes it dangerous. These foreclosures are accelerating while unemployment is still being officially described as manageable, and while parts of the economy are still labeled as expanding. That combination almost never ends well. At the same time, price momentum has broken. The national median asking price per square foot has slipped below 2024 levels, and the Case-Shiller National Index is barely holding positive territory, hovering around 1.5% year-over-year growth and drifting steadily toward negative ground. Buyers sense the shift. They are no longer competing, they are waiting. But this is not a uniform slowdown. The stress is highly concentrated in specific states where three structural forces are colliding at once. First, mortgage rates reset higher just as pandemic-era wage growth stalled. Second, migration patterns that once fueled demand reversed sharply, leaving behind excess supply. Third, ownership costs, insurance, taxes, utilities, and HOA fees rose faster than incomes, turning many homes into liabilities instead of assets. This is why price declines alone do not tell the real story. In many markets, even a cheaper home costs more to keep. Insurance premiums in states like Florida and Texas have surged. Property taxes in high-debt states continue to rise. Infrastructure strain, from water scarcity to climate risk, has begun to affect affordability in ways that did not exist during past cycles. And unlike 2008, many state governments are entering this downturn without financial flexibility. Budget deficits, pension obligations, and rising debt levels mean that when housing markets begin to fail, there is little capacity for intervention. No large rescue programs, no broad homeowner relief, no safety net. What we are seeing now is not a future forecast. It is pressure already visible in foreclosure data, inventory levels, and migration statistics. And in the 7 states we are about to examine, those pressures are no longer theoretical. They are already reshaping local economies and household finances in real time. If you want to follow how these stories unfold and understand where the risks are actually forming, make sure to like the video, subscribe to the channel, and turn on notifications. These are not abstract trends. They are playing out right now, city by city, state by state. 1. Florida. For years, Florida was marketed as a financial escape. Low taxes, endless migration, warm weather. A housing market that seemed permanently supported by retirees, remote workers, and investors chasing yield. That illusion is now breaking. As of October 2025, Florida recorded 1 foreclosure for every 1,809 housing units, the highest ratio in the country. In a single month, more than 5,500 foreclosure filings were logged statewide. What makes this moment especially dangerous is not just the volume, it is the direction. Foreclosures are rising while home values are already slipping. Inventory tells the same story. In Miami, homes are now sitting on the market for an average of 69 days, the longest timeline in the nation. Cape Coral saw listings surge 51% year over year. Northport and Sarasota climbed 48%, while Fort Lauderdale inventory jumped 30%. These are not seasonal fluctuations. This is exit behavior. The catalyst is not interest rates, it is insurance. Average homeowner insurance premiums in Florida have now exceeded $11,000 per year, compared to a national average near $12,500. That cost alone has turned many previously affordable homes into financial traps. Even owners with low fixed-rate mortgages are being forced to sell simply to stop the bleeding. At the same time, Florida's growth engine has stalled. Domestic migration collapsed from 201,100 new residents in 2022 to just 68,043 in 2024. The state recently recorded a net population decline, something almost unthinkable just a few years ago. As people leave, demand weakens. As demand weakens, prices fall. And as prices fall, equity disappears. When declining values collide with rising foreclosures, soaring insurance costs, and a shrinking population, the result is not a correction. It is a cascading failure. Florida is not struggling with a single problem. It is absorbing multiple shocks at once. And that is why it sits at the very front of this collapse. So if Florida is the clearest warning sign, what happens when a much larger system begins to crack? 2. California. California was never just a housing market. It was an economic engine. Technology, entertainment, logistics, and venture capital, all reinforcing demand for space, labor, and housing. For decades, scarcity alone kept prices elevated. That support system is now fracturing on multiple fronts at the same time. The state is facing a $58 billion budget deficit alongside nearly $498 billion in total liabilities, while experiencing the largest population loss in the nation. In a single year, 239,575 residents left California. That outflow is not symbolic. It is a direct hit to the tax base at the exact moment spending pressures are accelerating. Housing supply has surged accordingly. Active listings have exploded across the state, with several counties seeing inventory increases of 100% or more. San Bernardino listings jumped 120%. Kings County rose 130%. Ventura County climbed 50%. Days on market have stretched dramatically, increasing more than 40% statewide, an unthinkable shift for a market once defined by bidding wars and instant sales. Labor stress is adding another layer of pressure. California's unemployment rate has climbed to 5.5%, one of the highest in the country, while multiple metro areas are already posting price declines. Sacramento and San Luis Obispo are no longer isolated pockets. Weakness is spreading outward. Then there is the business exodus. Hundreds of companies have relocated over the past decade, including multiple Fortune 500 headquarters in recent years. Each departure removes high-income earners, office demand, and long-term housing support. Pension obligations, roughly $265 billion unfunded, continue to drain public finances with no clean solution in sight. As residents and employers leave, California faces an impossible trade-off: raise taxes and accelerate the exodus, or cut services and reduce livability. Either path feeds the same downward loop. This is not a sudden crash. It is a slow, structural unwinding of the model that once kept California afloat. And if this kind of breakdown can take hold in the largest economy of any U.S. state, what happens when a market built on nonstop construction loses its growth narrative? 3. Texas. For much of the past decade, Texas was treated as the antidote to high-cost America. People left California and the Northeast believing Texas offered cheaper homes, stronger job growth, and endless opportunity. Builders believed it too. They built accordingly. By 2025, Texas had become one of the most oversupplied housing markets in the country, with inventory sitting 53% above normal levels. Active listings climbed to roughly 123,000 homes, flooding the market just as demand began to cool. The problem was not subtle, it was structural. The growth Texas planned for never arrived. Net domestic migration into the state collapsed by 62%. falling from 220 to 100 new residents during the pandemic surge to just 85,200 in 2024. Yet construction did not slow. Texas issued 15% of all new home permits nationwide, continuing to add supply into a market already losing momentum. Nowhere is this imbalance more visible than in Austin. Once marketed as the next Silicon Valley, the city expanded rapidly on the assumption that remote work and tech migration would remain permanent. That assumption failed. Prices are now projected to decline by more than 12%, and sellers are competing not just on price but on incentives, rate buydowns, concessions, and extended listing periods. This is the classic boom and bust cycle, but with a modern twist. Many homeowners bought near the top with the belief that Texas was immune to national slowdowns. As prices soften, equity disappears. As equity disappears, mobility vanishes. Owners become trapped in homes that no longer function as assets. Texas is not collapsing because people stopped believing in it. It is correcting because it built for a population curve that reversed. When supply overwhelms demand, even a business-friendly state cannot outrun gravity. And if overbuilding can destabilize a market this large, what happens when a state built around finance and commercial real estate loses its foundation? 4. New York. New York's housing risk does not begin with single-family homes. It begins with office towers. In Manhattan, office vacancy rates now range from 17% to nearly 19.6%, levels once associated with deep recessions. Even top-tier Class A buildings are no longer insulated. Rents have fallen between 6.8% and 8% year over year, erasing billions in property value across the commercial sector. That damage does not stay contained. New York carries roughly $368 billion in total debt and a $34.3 billion structural deficit, leaving little room to absorb shocks. At the same time, population losses are accelerating. In a single year, 120,917 residents left the state. With them went income, spending power, and tax revenue, including an estimated $13.7 billion in personal income that relocated to Florida alone. When commercial real estate weakens, the consequences spread outward. Falling office values pressure banks and lenders. Municipal revenues decline as property tax assessments drop. Downtown employment contracts. And as urban cores lose momentum, nearby residential markets lose their anchor. This is the cascade effect. Residential housing in New York has not yet collapsed across the board, but the support system beneath it is eroding. Fewer workers commuting means less demand for proximity. Fewer businesses expanding means fewer high-income buyers, and fewer taxpayers mean tougher fiscal decisions ahead. New York now faces a narrowing set of options: raise taxes and accelerate outmigration, or cut services and weaken the very cities that once justified premium housing prices. Neither path stabilizes the market. Both increase stress. This is how housing downturns begin in financial capitals, not with a price crash, but with a structural failure that quietly spreads. And if a state built on finance can unravel this way, what happens when a supposedly stable market reveals that its strength was only surface deep? 5. Colorado. For years, Colorado was viewed as a safe market. Strong in-migration, high quality of life, a diversified economy anchored by technology, outdoor industries, and professional services. It was rarely mentioned in conversations about housing risk. That confidence is now being tested. Over the past year, Colorado recorded the largest year-over-year surge in foreclosure filings in the United States, with activity jumping 145%. Foreclosures did not merely increase, they more than doubled during a period still labeled an economic expansion. That alone signals deep structural stress beneath the surface. At the same time, the state's fiscal position deteriorated rapidly. In less than 12 months, Colorado swung from a comfortable budget surplus to a projected $750 million shortfall for fiscal year 2026. This kind of reversal does not happen in stable environments. It happens when growth assumptions fail. Housing supply pressures are also intensifying. Inventory levels have climbed above their pre-pandemic 2019 highs, while foreclosure risk continues to rise, with roughly 1 in every 429 homes now facing foreclosure. These conditions are unfolding as the state grapples with uncertainty tied to remote work reversals and a cooling technology sector. Even Denver, once a magnet for pandemic-era migrants, is showing visible cracks. Office vacancy rates remain elevated. Commercial demand has not recovered, and much of the recent residential development was built to serve a growth pattern that no longer exists. Colorado's situation is not about excess speculation or extreme overbuilding. It is about misplaced confidence. When a market believed to be resilient experiences a foreclosure shock of this magnitude, it exposes how quickly stability can dissolve once momentum turns. A recession does not create the problem. It amplifies what is already there. And if apparent safety can fail this fast, what happens in a state that has been bleeding slowly for decades? 6. Illinois. Illinois is not collapsing suddenly. It is deteriorating steadily, year after year, under a financial burden that cannot be outrun. The state is carrying approximately $144 billion in unfunded pension obligations, with funding levels sitting near 46%. Total pension liabilities have expanded to roughly $248.7 billion, while Illinois' debt ratio has climbed to 468.7%, the highest in the nation. These numbers are not abstract. They shape every fiscal decision the state makes. As pension costs consume a growing share of public resources, residents respond predictably. They leave. In 2024 alone, Illinois lost 56,035 residents to domestic migration, ranking among the largest population outflows in the country. Each departure shrinks the tax base further, forcing harder choices. This creates a closed loop. To cover pension obligations, taxes must rise or services must be cut. Higher taxes accelerate outmigration. Reduced services lower quality of life. Both outcomes weaken housing demand, even in markets where prices have not yet collapsed. Housing stress is already present. Foreclosure rates remain elevated relative to national averages, even as select areas have posted short-term price increases. Those gains are fragile. When a recession arrives, they are unlikely to hold. What makes Illinois especially vulnerable is its lack of flexibility. Unlike faster-growing states, it cannot rely on population growth to absorb shocks. And unlike fiscally healthier states, it has no reserve capacity to support homeowners when markets falter. This is not a boom and bust story. It is a slow-motion failure where obligations built decades ago are colliding with a shrinking present. And if long-term debt can quietly suffocate a housing market, what happens when affordability breaks down in a state that was once considered accessible? 7. Arizona. Arizona's problem is not speculation alone, it is affordability, fully and visibly broken. For years, the state benefited from a reputation as a lower-cost alternative to California. That advantage has evaporated. Between 2019 and 2023, housing costs surged far faster than incomes, pushing Arizona from broadly affordable into clearly unaffordable territory in just a few years. The slowdown is already showing up in prices. In Tucson, home values have fallen 2.1%, bringing the median price down to roughly $381,400. More importantly, forward-looking risk indicators have turned sharply negative. Core logic now assigns a greater than 70% probability that prices will continue to decline, signaling that this is not a temporary pause. Fiscal policy has left the state exposed at exactly the wrong moment. Arizona closed a $1.4 billion budget deficit in 2024, but did so without building a meaningful financial cushion. Earlier policy decisions, most notably the 2021 flat income tax cut, reduced ongoing revenue just as spending pressures began to rise. That trade-off limited the state's ability to respond when housing conditions weakened. Ownership costs add further strain. Insurance premiums have risen alongside climate-related risks, while higher interest rates have pushed monthly payments well beyond what many buyers expected when they entered the market. For households stretched thin, even modest price declines are enough to erase confidence and freeze demand. Arizona is entering the next downturn with three disadvantages at once: weakened affordability, declining price momentum, and limited fiscal flexibility. When economic conditions deteriorate, there are few tools left to stabilize the housing market or protect homeowners. Arizona does not need a dramatic shock to tip. The structure is already unstable. And when affordability fails before unemployment spikes, what does that tell us about where this cycle is heading? When cheaper homes still cost more. Taken individually, none of these 7 states proves that the American housing market is collapsing everywhere at once. This is not a repeat of 2008, and it is not a single national crash unfolding on a uniform timeline. But taken together, a clear pattern emerges. Across Florida, California, Texas, New York, Colorado, Illinois, and Arizona, the same assumptions failed in different ways. Prices were expected to rise indefinitely. Migration was assumed to be permanent. Costs were underestimated. And structural risks, insurance exposure, pension obligations, overbuilding, commercial real estate dependence, and affordability limits were ignored until they could no longer be absorbed. The most dangerous feature of this cycle is not falling prices. It is the erosion of flexibility. Homeowners lose equity. States lose fiscal room. Buyers lose confidence. When all three happen at once, markets do not adjust smoothly, they fracture. This is why the warning signs matter. Rising foreclosures during an economic expansion. Inventory climbing while sales stall. States entering downturns already burdened by debt and long-term obligations. These are not background noise. They are early signals of deeper stress. The lesson here is not that housing is a bad investment. It is that blind faith is. Markets built on leverage, optimism, and the belief that conditions will never change are fragile by design. When those beliefs meet reality, the correction is not just financial, it reshapes communities, migration patterns, and household decisions for years. The question now is not whether prices can fall further in these states. It is whether this is a temporary reset or the beginning of a longer cycle defined by slower growth, higher ownership costs, and more selective demand. If you live in one of these states, what changes are you already seeing on the ground? Are homes sitting longer? Are costs rising even as prices soften? Share your experience in the comments. And if this breakdown helped you see what's really happening beneath the headlines, make sure to like the video, subscribe to the channel, and turn on notifications. The next phase of this housing cycle is already forming, and the signs are no longer subtle.